Jerome Powell is set to speak at Jackson Hole at around 10 a.m. Let's bring in Thierry Wizman. He is a global FX and currency strategist at Macquarie. Thierry, thanks so much for being with us. How are you thinking about the setup going into Jackson Hole?
Well, you know, if the Fed really wanted to pat itself on the back for the job it's done over the last few months, I think there's a case to be made that it could. Of course, the inflation situation in the U.S. has receded. We're seeing headline PCE inflation about 3%, not terrible. Certainly has come down quite a bit. And we're also seeing, still pockets of strength in the U.S. So if it wanted to pat itself on the back, it could. But I don't think that's what's going to happen. I think there are still enough hawks on the FOMC panel who are, whispering in Jay Powell's ear and saying to him, look, it's not exactly time to signal that we should remove the tightening bias. So if that's the case, I don't think he's going to say anything new about the next few months' guidance or outlook. I think he'll stick to what they've been saying for the last 2 months or so, which is they are data dependent. But at the same time, there's still a tightening bias, and they have not completed the job of bringing inflation back to target.
Well, and part of that is because growth has remained so resilient. And if I could just throw one data point out there, and I'm curious your perspective, Atlanta Fed does this so-called GDP Now forecast. It is now projecting economic growth of close to 6% for the third quarter. Most blue chip consensus is definitely under 3%. That's the highest, but consensus is around 1.5%. There's a huge disconnect there between where we think growth should be and what it is tracking to be. But also that high number, while it's good, it probably is inconsistent with getting inflation back down to target.
Not necessarily. First of all, I don't think the Atlanta Fed's estimation of Q3 GDP is valid. If you look at their methodology, there are certain things in there that I would not put a lot of prominence on, including how they account for inventory investment in that estimate. I trust much more the blue chip projections, the consensus projections. Keep in mind, Q2 GDP growth in the U.S. was about 2.4%. There's no real reason to believe that Q3 is going to be stronger than that. There are a few reasons to believe that it could be weaker than that, especially in view of the problems we're seeing in the credit economy in the U.S. right now. So I don't think Chairman Powell would invest much importance into that Atlanta Fed estimation as well, by the way.
All right. So with that in mind, we did get, I guess, to your point, sort of contrary data about where things are going in the globe. We had PMIs released for the United States as well as Europe earlier this week, painting a picture of a slowdown both in services and in manufacturing.
Yeah, and I think this is the main reason why you've seen the dollar strengthen over the last few weeks. There's been a lopsidedness with regard to sentiment about growth outside the U.S. China and Europe have clearly slowed. Manufacturing in both economies was slowing already as early as the second quarter of this year. And by the same token, in the U.S., we haven't seen that kind of slowdown, certainly not in the service economy yet of any significance. Until that corrects, until we get more or better growth, relatively speaking, in the rest of the world than we do in the U.S., it's going to be very difficult to see the U.S. dollar weaken. However, if you believe that China's stimulus is going to be important and it's going to work to some extent to revive the Chinese economy in the back half of this year, and if you believe that the Fed is going to signal, not now, not this week, but maybe by September or October, the peak is in for Fed funds, those are the conditions that we would need to see before the dollar weakens. Yeah.
The China piece is interesting because so far the stimulus efforts have been muted, and in part because they're dealing with a much weaker currency. Wouldn't additional stimulus exacerbate that?
Depends what kind of stimulus. If all they were to do, for example, is rely on fiscal stimulus, prodding the local governments to do more in infrastructure, maybe some direct transfers to the consumers and households, they can spend more. No reason why the dollar yuan would rise from there. No reason why the yuan would be weaker. I think that's the kind of stimulus that would be associated, if it works, with a stronger Chinese currency, and you would see the knock-on effects for the euro, for sterling, for the Aussie dollar especially, the other commodity currencies around the world.
The loonie is one of those commodity currencies, or sometimes it is, and sometimes it's a rate story. But it has pulled back to about a 2-month low. How are you thinking versus the U.S. dollar? How are you thinking about the Canadian dollar and where it goes from here?
Well, it all depends on how the Canadian economy does in the context of a slowdown, which we may or may not get in the U.S. We believe that there will be a slowdown in the U.S. We believe that it will be consumer-led slowdown. And if there is a slowdown in the U.S., what we're saying is that Canada's economy could do worse in that context. In other words, the delta or the downward slope of Canada's economy can be more pronounced, more significant than the downside in the U.S. If that happens, if it plays out the way we think it is, you could see further upside in the dollar versus the loonie. Maybe we can see 137, 138, or even 139 by the end of the year. But that scenario has to play out for this to happen.